Sweet. Well, welcome to our latest Tuesday meeting. Today, we're really excited to have you guys on with Bill and Trish. For those of you guys who don't know, Bill is Link's senior loan officer. He's been with us for a little over a year now. Prior to joining Link, Bill was actually Andrew and my preferred lender. We use him for all of our borrowers. He always took great care of us, and so we wanted him to come over to Link when we started our mortgage division. Over 20 years of experience from conventional VA, FHA, jumbo, any type of potential loan that you think your borrower might be able to qualify for, and or if you don't think they can, he will probably be able to make it work. So he's really here as a resource for all of our Link agents, for all of your clients. Go to him with any questions you might have, even if you think it's an impossible loan. We could probably try to make it work. Trish is here with NewFi to kind of
That's a
run.
little bit of overpromise, I think, or at least
He
he'll be
can
able to
try to
tell
make it
you
work.
what you can or
Well,
you,
hey, it's always worth sending it by, and we can at least talk about why it would
yeah,
work, why it wouldn't work, what might need to
Yeah.
change in order to
that's
put that person in
a
a
little bit
position
safer,
to
safer.
do it. So I'll take all comers, bring everything.
And I emphasis on the try to make it work.
Yeah.
If he can't, he will tell you up front. He's not going to string you along, obviously. Um, but yeah, and then Trish is here with NewFi. They're one of our direct lenders we work with. They do a ton of great programs, both for the QM side, non-QM side, jumbo, you name it. And she will probably take a deeper dive into everything. But yeah, I will let Bill kind of take it away.
Sure. Yeah. Thanks, Kobe. Thanks, Craig. So yes, been with Link for about a year, and really enjoying working with these guys. And for us, we're still a brokerage, and you'll see on my stuff, it's Mindful Mortgage Solutions. That's my white label brand, which is so cool that we can do that through Link and kind of keep our own our original marketing original stuff without having to change everything up. But yeah, I've been doing this for a long time, and as a broker, what we do, we kind of work like you, right? Like we're independent, and then we're contracted to work with a number of different lenders to help find the best loan for your client. So NewFi Wholesale is one of those lenders. They are a California-based wholesale lender. They focus in non-QM lending, non-conventional mortgages. So that's going to be, it's not going to be like your full doc Fannie Mae, Freddie Mac kind of loan. Probably not going to be a down payment assistance kind of thing. But if you have self-employed borrowers who write off everything, potentially yourselves as real estate agents, that's most of you guys, I'm sure. There's a ton of options, and Trish is here to discuss those today. And beyond the fact that they can do all of this stuff, there's a lot of people who can do all this stuff, and the rates are just terrible. NewFi always comes up with the best rates out there. I'm doing a second loan right now, and I priced it out with 10 different people, including big names like Rocket Mortgage and PayMac, and their rates were still superior. So very excited to have her here today. We worked together forever. And Trish, what do you got?
Good morning. Well, I'm glad to be here, guys. Good morning, and it's a pleasure to be invited. I do work with Bill and Tim, and they're pros. I think our world has changed a little bit. I think we more partner than it's a lender and a client. The deals that we get, the purchases, the refis. Every borrower has a story right now, and they're all different. They might think that it fits in a box, but it may fit in part of the box, and then part of it hangs out of the box. So I think, as you mentioned earlier, to run those scenarios by Bill, because there's so many layers to guidelines now that there's a solve in many cases. What is the issue? And the thing about non-QM, which is cool, is it's not necessarily like some people would think maybe subprime. It's just more creative financing. Bill mentioned it's a lot about self-employed borrowers, which is wonderful, because they could be creative with their taxes. So, but they make the money. They could show deposits. There's many different ways to go with that. So we have those solutions, and if we can't come up with a solution, then there can be a game plan to, okay, within 3 to 6 months you do this, and we can get you into a house, which is the end game, right? So I think we have some great solutions. Bill, do you want to share the screen now, or we're gonna do that in a
Sure.
minute?
Yeah.
Okay. So we have a little flyer here of some of our niches, but if if I may, I'll just start talking about some of them, which I think will be really important to realtors. You can see their loan amounts, you do go up to 5 million. The great thing about NewFi is that we are the investor, our equity partner Apollo, so we can make exceptions to pretty much all these guidelines. So if there is a transaction that is above 5 million, we can vet it, get it priced prior to any offers accepted, and get the blessing ahead of time, which is really great. So there's no surprises. We don't like surprises. Purchases, 10% down, we do bank statement, which is, you hear a lot about that right now. What exactly, how do you qualify someone on a bank statement? That's something that Bill and I'll do, vet it prior to. Again, you want to pre-qualify these borrowers ahead of time. So when you make
and I'll say, if you guys aren't familiar with bank statement loans, what that means is that rather than showing a tax return, we'll get 12 months of your customers' bank statements. They can be personal bank statements, business bank statements, sometimes a blending of both. And NewFi will review them, add up all of the deposits that they have, and it's going to be deposits that appear to be income deposits. If it's transfers from one account to another, those aren't going to count, but they'll get that all added up, and that's how they calculate the income. And typically we can use 90% of those deposits if we can get a letter from a tax preparer showing that their expenses are 10% of their revenue. If we can't get that letter, it's 50%, right, Trish? We can use half of those deposits as their income.
Yeah, that's correct. Yeah.
Okay.
Yeah.
All right, go ahead. Sorry to interrupt.
Oh, no. And then, as you can see under that, we have a wide variety of alternate docs, bank statements, CPA gross receipts, CPA P&L, 1099, asset depletion, all different ways of qualifying. And that, again, why the story is so important to be vetted ahead of time. A 1099 example, just borrowers 1099 for the last, year, and something to support what current income is. And it's, a real estate agent, a consultant, you can get 90% of that income. And so that's a great way to, again, qualify these borrowers. Again, we offer asset depletion. So I will tell you one thing that's really cool too, is you can do a lot of layering, right? So the borrower may be self-employed and you're utilizing bank statements to qualify them. They may also have some assets, an IRA or a stock account. We can use that as income as well. So, you have that borrower that the ratios are 55 or 56. How do we work this borrower so they can afford the house that they really want? And that's a great way of doing it. Our asset depletion formula is we take their asset, depending on where it is, maybe give a haircut if it's a stock account, divide by 60 months, and there's your income just by showing us their asset. And that can be used again in addition to full doc. So maybe they're W-2 full doc, employee, but they need some additional income to qualify. There's so many ways of putting the deal together. Again, our product and our guidelines are proprietary. So it's really giving you the upper leg on qualifying these borrowers. How can we get them into the homes that they want, right?
Yeah, and I'll just jump in again. A lot of times with NewFi, we'll have a deal that'll come in and something will jump out that would get it declined elsewhere, and it's maybe not within their normal guidelines. Trish takes it up to the top and gets it reviewed, and 9 times out of 10 they say, okay, we'll make an exception on this. Sometimes there'll be a little bit of a hit to the, not even necessarily to the rate, but the cost of the rate, and so that happens, but we get a lot of deals done that way that normally wouldn't be able to be done.
Hey, Bill, let me jump in real quick.
Mhm.
And this is what a lot of our agents will continue to hear me say, but building your team around relationships, right? So Bill has a relationship with NewFi. Being a broker, he has the opportunity to go to, I think we have 20 different banks we're qualified with. But when it comes to dealing with title or escrow or your lender or your lender's lender, right? We're not a direct lender, so we're not beholden to one program or one bank. Bill has the opportunity to go to a bunch of different banks, but when he's talking about using NewFi in this scenario, he's already built these relationships with these guys. And so when there is an issue, whether it be with NewFi or down the road with title or down the road with escrow. The deeper these ties go, uh, the easier it is to get things done. And so that's why when we start to push our vertically integrated services, we want to try to get our agents to build their teams as deeply as possible. So, Bill, if you want to speak to that a little bit and explain the difference between being a broker and being a direct lender, let our agents know really what the benefits are to that.
Sure. Yeah, I'll take this away for a second. So essentially, and I've worked as a direct lender as well, right? A direct lender would be a bank. So Chase is a direct lender, Bank of America, all those things, right? So they are operating under guidelines for that one bank. So if something about the loan doesn't fall within those guidelines, they're just going to say the loan is declined. For us as a broker, we have all of these different options. So most of the time, we're going to suss out the issues ahead of time. We're going to speak with our lenders. Um, be open with them about, hey, this is what's going on here. Can we get around this? And they'll let us know yes or no. Sometimes it comes up in the middle of the file, and it comes as a surprise, and we still have the opportunity to move that loan and get it done somewhere else. So we have a lot more flexibility that way. And as just like Craig was saying, I mean, Kim and I both have over 20 years experience doing this, and I'm not sure how long we've worked together, Trish. It's been at least 8 or 9 years, and it makes a huge difference. We really are able to kind of make moves. And then when it comes to escrow as well, we'll mention that because Beth at Linked Escrow is amazing. We're building our relationship over this past year, and Angie as well as the other lady there, and they're awesome. And escrow is such an important part. Escrow and the loan. I mean, if you have an escrow company that messes things up, it is going to completely ruin the trust between you and the client and the buyers, the sellers. It's really important. And same thing on the loan. I'm sure you all know, like the scariest thing that happens. It's like, okay, we've got our deal, we've got our inspections, everything looks good. Now we got to hand it over to this guy and hope that he gets it done. So, we pride ourselves on being able to make that happen.
And I didn't want to sidetrack you guys too much because you guys had a good flow going. But a big thing that we're gonna be pushing too is allowing our agents to make moves with competing with wholesalers, right? We are going to offer out cash offers or different types of investment loans. And you guys were just going over these niche loans. Can you dive a little deeper into the DSCR loans and explain how those work and how we can get our agents to go from agents to investors and I guess that transition?
Sure, for sure. I can speak to DSCR. So, debt service ratio loan basically is a business purpose loan, and it's looked at very different. It's non-trade, so it follows different guidelines. You don't need a CD. Disclosures don't need to be signed in many cases, and as you mentioned, it competes with private money because you can close very fast. The only thing you're waiting for is the appraisal. And what we're looking for in this is pretty simple formula: is rents versus payment. And the rents need to be the same or greater than the payment. There's different options on qualifying. You can qualify interest only. It's probably one of the only programs you can actually qualify on an IO payment. And investors, are looking for it's all cash flow, if it makes sense, right? The numbers, the rents cover the payment. It's really a no-brainer. So those are available with as little as 20% down payment. And they offer 0 to 5 year prepay options, which helps. So with the DSCR program, the most important thing is what do we anticipate the rents are going to be? So we always start there and then back into how much can we qualify for. But again, there's no income. There's on the application, we don't verify anyone's income or job or employment. It's all based on, down payment, what the rents are going to be, anticipated rents. In some cases, you can do short-term rents if it's a vacation home, on the beach somewhere. So there's lots of different ways of coming up with that formula, but it basically can put you in a property as an investor, multiple properties. We tend to see, borrowers taking money out of here, 2 properties here, buying 3. It's that solution. You could take cash out of a rental property, DSCR, and purchase something. So it's really enabling those borrowers that don't need to qualify on their own. We allow entity vestings. It's very common to see entities, buying these properties, and that is allowed. So on any investment property, actually, with us, you can invest in an entity. So the LLCs, specifically set up for real estate purposes. But it's fast. We close these in 8 days before. So, if the assets are there, 1031 exchange, however you need to come about it, the DSCR is a wonderful solution. And
How do those rates compare? I know rates have come down a little bit. Where are rates today, conventional Fannie Freddie versus a DSCR loan?
well, I can speak to DSCR. Again, we're not necessarily a conventional lender, so we don't offer those rates, but I mean, they can be as low as, in the low sixes, 6 and an 8. And upwards depending on, credit score, units, loan to value, et cetera. Maybe up into, the 7s depending, but again, you can offer interest only, which is really great. And again, to qualify, you can offer that interest only. But so rates are very
Well,
competitive.
one thing to say about interest only too, I talk to a lot of people, they're like, well, I don't want to only pay interest on the loan. Usually the rate on the interest only is pretty close to the rate on a regular 30-year payment plan. So if your client really, we'll use the interest only to qualify, and they can make a regular 30-year payment and still pay down the balance. You're not forced to make that lower payment. You can always pay a little bit more and do it that way. The interest only just helps to qualify if the rents are a little bit lower than where we need them to be.
Another thing that's really key about DSCR is that there's no limit on how many properties the borrower owns. So you have those investors that own 30, 40 properties, 100 doors, whatever, right? You try to put them in a jumbo loan or a full doc loan anywhere, there's going to be limitations on how many properties the borrower has. So that this is truly an investor product, right? Somebody that, as you mentioned, would like to become investors. First-time homebuyers are unfortunately are not allowed. So we do need to at least own your primary residence to be able to offer DSCR. But again, it is going to enable those true investor borrowers, as long, there's so many properties out there, especially, in California, that debt service beautifully. Rents are high right now, right? So it's a good time to be offering these, cashing out or to reinvest, as I mentioned. But that's pretty much the formula. And again, Bill can just run those numbers and we back into it. We can run market rents. We'll use all different tools, Zestimate, RentCast. You can use an appraisal, to figure out what the market rents are going to be. That's super important. And usually someone that's purchasing is aware of that, right? We can offer up to 4 units, single family, condo, etc. And anything you want to add to the DSCR, Bill? I know we've done quite a few of those.
Yeah, I mean we do them all the time, and it really has been a huge game changer in the industry because since 2008 there's been no kind of stated income loan available. In this you're not stating income, you're simply just qualifying based off the property, but you don't have to worry about the borrower's income. And as far as investors, she mentioned trying to do a full document loan for an investor who owns multiple properties is an absolute nightmare. You essentially have to get the mortgage statements, the insurance information, the lease contracts for every property that client owns. I've done a few of them, and everybody is ready to kill each other by the end of it because it's such an ordeal. But the DSCR takes all of that out of the equation and makes it all happen really fast. And then as far as figuring out how much the rents are, if you're looking for investment properties for your clients or for yourself, you do want to be aware that if you buy a property that has tenants in it already, they are going to use the rents that the tenants are currently paying as opposed to the market rent, which here in Los Angeles can be a problem because we have rent control, and you'll see these great properties like, wow, this one's only $1 million, but it's got 4 units and each tenant is paying $800 a month, and that kind of ruins the deal. So one thing to keep in mind, but there are, there's always option, but the DSCR is amazing. It really has been a game changer.
Yeah,
Cool.
and in some cases it's ease of flow. Sometimes the borrower could go full doc, but it just makes more sense. The property debt services, so pricing's very competitive. Let's keep it simple. Let's close quickly. Less conditions, happy customers, close early. That's a good thing too. So it's DSCR is definitely to be aware, become an expert on it. Again, it's less documentation. And there's so many sources out there, you know, property managers and just everybody knows somebody that has an investment property and they don't know, but everybody hears debt service ratio, DSCR, but what does it really mean? So to become an expert in that as an agent is something that is I would recommend definitely.
Yeah, and I'll reiterate. So you did mention Airbnb is you know, I believe it has to be in an area where they actually have Airbnbs. You know, if it's just kind of in a random suburb that doesn't do this, it's not really going to work. But we've done a bunch of them up in Big Bear and you know, down by Disneyland, or you know, there's a lot of areas where you can do these deals, and maybe the market rent for a regular rental is going to be, you know, be considerably lower than it would be for as an Airbnb. And they use this tool called AirDNA, which is pretty cool. You have to pay for it, but if you're interested in buying an Airbnb, sign up for AirDNA. You type in the zip code of the area that you're looking at, and it will like give you all these statistics on what that market looks like, how successful it is as a short-term rental market, what you can expect for rents, all this stuff. And I mean, it's the data must be good because the lenders are using it as their guidepost to determine whether or not they feel like someone's going to be able to pay their mortgage. So it's something to check out.
Yeah, absolutely.
Anything else?
Can we touch on some of the other options that like
Absolutely.
I personally, there's some favorite niches that I know Bill and I work with on transaction I think is maybe appropriate, you know, given what you do. We have a lot of borrowers right now that are having departing residents and maybe they're not sold yet, or they're going to put them on the market. They're not sure if they want to rent them, and it's inhibiting them from purchasing their home. So what we offer here and work with Bill on many transactions is we have a departing resident guideline where we'll actually just take the market rents and take 75% of those and apply it to offset the PITI on the departing. So we'll basically give them credit without them putting it on the market, securing a lease and a tenant, and that'll, you know, help with the debt, you know, the borrower qualifying for their new purchase. On the flip side, we've put many of those same borrowers into an interest-only loan. So when they do sell their departing residence, they can pay down that loan, and on an interest only, it automatically recasts based on the loan balance. So it's kind of a great solve for borrowers that are in those positions that have a house to sell and, you know, are going to put it on the market or going to rent it or whatever. And this again is really ease of flow to making the transactions work. So that's kind of a niche guideline that we have here that I know Bill.
No, just jump in really quick.
Yeah.
When Trish says recast, what she means, it's like, okay, you're going to buy a new house for $1 million. You're going to pay $800,000, or the new loan is going to be $800,000. So you're paying, let's call it $7,000 a month. That's just a ballpark. It's probably not that high, but $7,000 a month. Once you sell your house that you're relocating away from, say you're going to walk away with $400,000, you can then put that $400,000 onto the balance of the loan, and they'll reset the payment. That's what the interest only will do. So instead of your payment being based on an $800,000 loan, now it's based on a $400,000 loan. It comes down to $3,500 a month or whatever it might be, and you know, you can move forward from that point. Most loans don't allow for recast. We do have some conventional lenders who are allowing it now, but it's, you know, it's fewer and further between, and especially with non-QM stuff, this is the way to do it. And it's really made a big difference for a lot of people who, you know, if you've ever tried to do a contingent sale or try to you know, it's a very tough thing to manage. So for most people, if they can get into a new home while they're trying to sell their other house, it can be a bit of a game changer.
Hey, Bill, on that note, so one of our things we offer is a buy before you sell program. And so obviously it's with a different bank, but this obviously is a competitive option, probably even a better option than we currently offer. So can you speak to that, or do you know much about that buy before you sell program, or how would this work to compete with that?
Yeah, so you know, there's a lot of lenders that do bridge, essentially like bridge loan program, which is what I'm assuming this is would kind of be like, or and they work in different ways. Sometimes the lender will like almost buy the other house, buy your house, and then sell there's a number of ways that they put these things out there. Usually you need to have a lot of equity in the home that you're selling already in order for it to work. Um, which can be the biggest deterrent. The other thing is that it's typically pretty expensive. You're probably going
Very
to pay
expensive.
points on both transactions. So this this gets you out of the excessive fees, and it also gets around having to oh, sorry, just lost my train of thought. So yeah, the fees are a big thing though, and really you just need this works in this scenario. This situation works better if you, as long as you have enough money to put down on your new house, right? Already saved up. If you need the proceeds from the sale of the home in order to buy the next home, that's where you would use the buy before you sell program. But again, the house that you're selling needs to have a lot of equity in order for one of those things to work. And there's other ways we can do that too. Honestly, like we can always just do a second mortgage on the other house and pull some cash that way. There's a lot of ways to do buy before you sell. So, we definitely have options there. I would say the other thing with what we're talking about with recasting, there is a chance, if you don't sell your house within a month and a half or a month, there's a chance that you'll end up having to pay mortgages on both of those homes, if we use an interest only recast kind of program. So, you've got to be prepared, but that's something that we're going to go over with every borrower and review their situation and just make sure that we're not throwing them into a spot where they're risking a situation where they can't afford to keep either house, or they find themselves falling behind.
Options.
Mm-hmm. Options, exactly.
Also, I'd say that the buy down, 2-1 buy downs. I don't know if you're seeing a lot of those, or I think that 2-1 buy down, especially given the market, a lot of borrowers are thinking rates are coming down, the sky is falling anytime now, and waiting for those rates to drop a little before they buy a property. But sellers are motivated, and we do see a lot of seller credits. So why not use those credits to do a buy down? So we can do the math, Bill can do the math and figure out this is how much it would cost to do a 2-1 buy down. And in many cases, you're buying that seller is buying the rate down for year one in the upper 4s, year 2 in the 5s, and then final note rate in the 6s. So that concern of rates, coming down and missing that or wanting to wait, I think it really answers that call. And we allow that on jumbo A paper, which is just the full doc A paper jumbo borrower, as well as our non-QM borrowers. So I think that's a great solve for those sellers that are already looking to give a credit, and it's a good use for those funds. And I think it's a kind of a step up program for the payment for the borrowers as well. So
we are doing a lot of those, and 2-1, if you're not familiar, it basically just means that you're going to have whatever the set interest rate is, but with the 2-1 buy down program, the interest rate is going to be 2% lower than the actual rate in the first year. So if your starting rate is 6.5, you're going to be paying 4.5% on your first year. The second year you'll be paying 5.5%, and then it's going to move back up to the 6.5%. And the idea is going to be that you should be able to refinance into a 30-year fixed set rate from that point, at some point before the 2 years is over. Another cool thing about this program that's important to note is that the seller is paying for the cost of the buy down. So essentially, however much money you're saving per month for all of those 24 months, that's how much the buy down costs. And that money gets set aside at closing. So if we refinance your loan in 6 months, all of that extra credit that's sitting there that was supposed to be used to pay down your payment just comes back to you. So if the buy down costs $15,000, but you only use $4,000 of that money, when we refinance your loan, you're going to get a separate check for $11,000 from New Fire, whoever has the loan.
So in essence, the seller's just prepaying 2 years of interest for you.
Yeah, exactly. They're subsidizing your payment for the first 2 years.
And that credit can also come from the agents as well as the seller. So it just can't, the borrower can't pay for their own buy down. But again, it's a good solution. We're seeing more and more of them. And the key with the buy down is you want to get ahead of that, right? You want to be presenting that at the offer stage, not renegotiating later. Sometimes we'll see them increase the price a little and want to then add the buy down. So it should be done in the beginning and as part of the selling points. But it's really, really great. And I think Bill, you have some flyers and good stuff to, for the agents to be able to market these products, which is kind of cool.
Yeah, absolutely. Absolutely. If you guys ever do, want flyers for your open house, we can provide this kind of stuff and, get your picture on it, make it look nice and give you some extra ammunition when you're talking to buyers.
Exactly. Another really cool niche that we offer here is that we allow the primary wage earner, and this could be again on an alternate doc like bank statements or 1099, et cetera. We'll use their middle score to qualify, where 99% of the other lenders out there will use the lower of the two. And why is that important? Why is the credit score so important? Well, credit score is going to drive your interest rate, and it's also going to allow you, to fit a product guideline. So if you need a 720 middle credit score to do a 10% down bank statement, that's going to enable you to do that by using the primary wage earners middle score. That is very unique, and it will set your pricing, your what you can do versus the competition apart. And again, what makes us different, what makes you different, what is going to bring the transactions to you versus someone else. So again, what's Bill's presented here is a lot of information, and I certainly won't go over it all. But these are key things that, again, what is gonna set your borrowers, how are they going to get that house? How are they going to be able to qualify it over somebody else and get the best pricing, right? So that's something.
Yeah, that credit score example is really important too. I mean, there's a lot of times where it's like, okay, we've got a husband and wife, and maybe they're one of their children, and all right, we need all three of those people's income in order to qualify them for the loan. But one of them, maybe the kid has bad credit, but makes less money. We can still use the parent's higher credit score and include the income from the child, and that is going to allow them to actually get the house that they're looking for. So, or maybe it's just a husband and wife, whatever. It's not uncommon for one person to have bad credit. A lot of times I'll see couples coming in who've gotten together and one of them has been divorced, and the person who's been divorced just got their credit trashed in their divorce proceedings, and but their new partner still has good credit, and as long as that new partner makes more money, we can use theirs, and it makes a world of difference.
Yeah. So that's a great alternative too. I mean, again, what differentiates us, right? And I think that these are key. There is so many different options, right? Being creative. Bill, I don't know if you want to talk about the W-2 to 1099 niche that we offer here, which is kind of cool. A lot of times you have a borrower that is, let's say, a good example, a doctor or a consultant that's has been W-2 for the past 5 years, let's say, and now all of a sudden they're 1099. That would typically be an issue. Most lenders would tell you need to wait till you have a full tax year, again, to qualify, because how do we know what are you writing off? But there's a niche product that we offer for these borrowers that will allow you to, as long as the employer confirms there's no expenses, which is very, very common for doctors, attorneys, etc., consultants, educators, we'll use the 1099 income with confirmation that there's no expenses as part of their job, and that's considered full doc. So you've just taken a borrower that's a brand new 1099 and have put them in the best possible pricing that they can, again, enabling them to get into more of a house that they'd like, and being able again, utilizing full doc guidelines, which is super cool. I think, all of this speaks to everyone's story is so different, right? And how do we put this borrower with their scenario, two different careers, different assets, et cetera, into, the best possible program. And that's, what Bill can do for you.
Yeah. I think to kind of bring it all together, there's so much,
Yeah.
so many opportunities out there, so many things that we can do, and on top of all of this, like the guidelines are changing quite a bit. So one month maybe we can't do something, the next month maybe we can. So again, just really want to encourage y'all to give us a call, run your scenario past. We'll do our due diligence and make sure that if we can do it, we find a home for it. If not, we can't do it, and make sure to also explain why and how and all of that. But don't disqualify somebody before running them past, because you just never know.
Sweet. We could open it up for kind of some Q&A, I guess. So we have some of our agents on here. For those who aren't watching live, you can always email Bill or call him with any questions you have. But anybody that's on right now, any questions you have? I know those are a lot of different loan programs, loan types, a lot of different acronyms that were being thrown around. So I guess any questions you guys have for either Trish or Bill, you can either throw them in the chat or raise your hand. Or maybe you guys did such a good job that nobody has any questions.
We're all experts now.
All right. Question came in. Multifamily situation. So every loan product that you guys talked about, obviously it could be for 1 to 4 units, right?
Correct. Yeah. I mean, almost. Yeah. I'm not thinking of anything. I can't think of anything that would not qualify 1 to 4 units. We do have some other options that will do, more than 4 units as well. Not with NewFi, but yeah, that's definitely available.
So I guess, yeah, something to kind of touch on, even if it's 5 or more units, 10 units, whatever it is, we could potentially have a different lender that might be approved for it. So feel free to pass any commercial deals, residential deals, no matter what type, over to Bill.
Sure.
Brenda asked, do you have anything for investors and new builds?
Yes, we do. I mean, typically, it's going to depend on the scenario, but typically it's going to be a hard money type of loan. If it's a new build, I would say, construction loans are generally private money. If it's an investor, like let's say it's a home that's already in place, but it's just in awful shape and needs to be fixed, we have renovation loan programs that are pretty cool, where you can borrow the money to buy the house plus the money that you need for the renovation. When you go through that process, you're going to get a quote for all the work that needs to be done. It needs to be done by a licensed contractor. When we order the appraisal, we'll include the quote for the work, and the appraisal will be done based off of the finished product. So that's a pretty powerful program. We do have a lot of experience with that.
Sweet. I guess a couple of just macro questions for either Bill or Trish. How is the overall market? That's obviously the number one question most agents get, is they'll talk to a buyer and it's like, well, how's the market? Is it a good time to buy? Is it a bad time to buy? Is it a buyer's market? Is it a seller's market? Any insights on just market in general? Where are rates at? Where are they heading? Yeah.
Yeah, I'll take that one, I guess. So the interest rates, actually, we've made some pretty significant moves downward just in the past couple weeks. The conventional rates are, we can certainly lock in a 30-year fix in the upper 5% range. The ARM, 7-year ARM, so a loan that's fixed for the first 7 years and then adjust after that, we're seeing them in the mid to low fives. So that's pretty cool. We're finally getting a little bit of movement. It's all come based off of these jobs reports, showing that the employment economy is not nearly as strong as they've been telling us it is. So when it comes to interest rates, there's kind of two main factors that are going to help them come down. One of them is going to be inflation. If inflation is high, rates are going to go up because money is worth less. So the lenders want to charge more interest to make sure that they're not getting less than inflation. But on the flip side of that, if the economy is going slow and we're showing like that there's not many jobs out there and GDP is down, all of those things, those are going to encourage the Federal Reserve to reduce the rates to try and help stimulate more activity in the economy. So if you're looking on a macro level, those are the things to watch. Inflation is the enemy. A slow market, a slow economy is good for mortgage rates. Let's see, I see another one here. It says hard money versus private money. It's the same thing. Yeah, same.
Different terms.
Different terms, right? Let's see, Andrew. Borrowers who are self-employed, with fluctuating income, what do you need up front so roadblocks aren't hit later? So it's going to depend on the situation. If we're doing a conventional loan, for a self-employed borrower, they're looking at tax returns. So if the most recent tax return has a lower figure than the previous year, they're just going to use that most recent year's tax returns. In terms of a bank statement loan or non-QM loan, Trish, what do you think on that? I mean, if that can come up sometimes, right?
Yeah, absolutely. So with bank statements, we're looking at deposits. So depending on, what their business is and what percentage of ownership, we'll look at all the deposits. And I mean, I always recommend doing both. You're going to provide the tax returns to bill as well as the 12-month bank statements, and whichever will give the borrower the most income is the route to go. If there's a decline, I mean, again, every story is different. In some cases, we're doing a loan right now for an artist, and he doesn't have deposits every month. There's deposits 4 times a year, substantial ones. So, we're going to look at that a little differently. Seasonal work, realtors, their deposits are not necessarily every month. Sometimes, huge checks every 3 months. So we're just going to quantify that, possibly 1099. So you're kind of going to get all the documentation provided to Bill, and then he'll see which one will offer the best, the most income really, to give them the most opportunities. So, but a decline in income is something that we still allow, even on a 12-month bank statement. We're just going to be conservative and probably look at the most recent 6 months for their income. But
and we need to know more about the story, right? What
absolutely.
do they do for work? That's usually going to be the if we can craft a nice story, if they have a nice story to tell, then we can usually.
You're like their doctor and their attorney. You want to know everything.
Right. Yeah. That's another thing about a broker compared to working with a bank. On that note,
yeah.
I don't want the clients to hide anything from me. I'm not going to share the things that don't need to be shared with the underwriter. So, but if I don't know about them and they come up, there's not much I can do to get around it, or if it's something that we couldn't get around anyways, probably want to know that up front rather than running.
Structuring the file is so important, and you could structure a really good, strong borrower in a bad way, and they have troubles through the transaction. And if you take even a tough borrower, and as long as it's structured and everything's addressed, vetted up front, it's smooth all the way in a close. That's the most important thing. So much is riding on these transactions, and we understand that. Your relationship, your referrals, etc. Right? So getting with Bill or Tim and vetting it from beginning to end is the way to go for sure.
We got a few more here. It says, what are the rates on renovation loans? Typically about 0.5% higher than a regular conventional loan. And with those programs, you can, they are Fannie Mae, Freddie Mac programs or FHA. So you can do it for a first-time buyer with 3.5% down or 3% down on conventional. So the rates are a little bit higher, but not significantly. Let's see. And credit scores, how low can they be for different programs? So if you have a borrower with a credit score under 620, they're almost always going to have to go FHA. in today's world. In the past, we had a lot of low credit options, but like Trish mentioned earlier, this is not subprime lending. We don't have subprime lending anymore, which meant, back in the day, it was like, oh, you've got a 500 credit score and no equity in your house. Sure, we'll give you a loan. No job, whatever. We don't care. But it's not like that anymore. Like they still want to make sure that people can afford to make their payments, and they want to make sure their position is strong so that there's some equity in the house. Sometimes you got to put yourself in the position of the lender at times and say, okay, would I give this person any money to buy a house? Like, am I going to give this person $1 million? If they've got a 500 credit score, probably not. But that said, with FHA loans, we can go as low as 540, I believe. Like, they can go pretty low if they have other good compensating factors. 620 on an FHA loan. We can do pretty much the best that they have to offer. For most of these non-QM programs, I believe 660 or 680 is going to be the minimum credit score to get into like a bank statement loan or DSCR. That's about right, isn't that, Trish?
Yeah, and one thing that's that we allow here, which is a little different, is that if you're within guidelines as far as your credit scores, so you have a 660, we will let that you actually change that score during the transaction to improve your terms. So if they have a 660 credit score, but paying down some debts will get them to 700, and that's a pickup of a quarter in rate better, we'll allow that to be happen during the transaction. So the bill could submit the loan, get you loan approval, and the borrowers could pay down some of their debts and rapid rescore, and then you'll be able to offer them better pricing. So
yeah, a little bit on that. If you guys aren't familiar with the rapid rescore, this is something that we have the ability to do. So when I run your client's credit report, it's going to give me what their scores are, and then it's going to give me a potential score. So for each of the bureaus. So they might be at 620, but it'll say, they could potentially be at 700. So I'll pull this separate report, credit expert report, and it'll say, okay, if they pay down this card by this much, this card by this much, then we can get their credit score increased. So what happens is the client pays down those credit cards. That's generally the answer, is to pay down revolving debt. Sometimes it might be to remove an authorized user on an account or close an account. Every once in a while, there's other recommendations, but usually it's just pay down some credit card debt, and the credit scores can go up significantly. So that's something to keep in mind. And the rapid rescore, it takes 5 days, maybe 7 days, but as soon as they pay their stuff off, they show proof. We send it into our credit company, and they get it fixed. So it's a pretty cool program. And some lenders do not won't allow you to go through that process. They want to see it done before you get the loan going, and NewFi is not like that. They'll allow us to get the loan started and do the credit repair at the same time.
Sweet. Anything?
How about derogatories? Who do you guys use for credit repair, and can you talk on that at all?
I don't know. Honestly, I've had, my clients have had luck with Lexington Law, but I don't really have like a go-to credit repair person who I've ever felt 100% comfortable recommending. I think situations are different depending on the person. I do have a borrower right now actually with NewFi, and he had a collection fraud show up on his credit report, and was able to. I'll find out who his attorney is, and I can maybe that
Cool
somewhere we can get it. But yeah, if you guys have recommendations on that, I'd be happy to know as well, because it's one of those things that's tough. I mean, if you can prove that something's done in error, I think you can usually get it off. But getting a creditor to come back and say, oh no, we made a mistake, we weren't supposed to do this, it's tricky. Although there's actually another one that we got done recently. This guy, he was talked into going into a loan modification, and so he didn't make payments for 4 months on a house that he was selling, and the house sold. This loan was supposed to go to NewFi, and they're like, why did he make 4 payments all in the same month? I'm like, well, but it only shows 1 30-day late on the credit report. And so we had to wait and send that loan to a different lender who's not going to ask for that bank statement that shows all 4 payments made at once. But we were able to get the credit, get the lender to come back, because it was another lender who I work with. They're called New Res, and they were the ones who had done this whole thing, and I was able to call my people over there, get them to get on with servicing and force their hand and get them to write a letter. So in some cases, like with mortgage stuff, we might actually be able to help on that.
Sweet.
Cool. Yeah.
Any departing thoughts that either one of you guys have for everybody? I'm going to, obviously this will be pre-recorded or recorded. We'll send it out to the rest of our agents, include both your guys' information on there. If you have any questions at all, obviously call or email Bill. We got one more question that just came in.
Yeah, I see this one. Thanks, Andrew. Loan terms or strategies that agents can highlight in their offers that will make them more competitive. I feel like maybe that's as an agent, you probably have a feel for what they want to see, right? I mean, usually it's faster turn times, which is something that we can do. We can usually close in 3 weeks. It'll be quicker inspection periods, waiving contingencies. If you ever are curious about waiving contingencies, I'm open to that if we have a chance to look at the file ahead of time. So that's something. One thing that I do that I get a lot of really positive feedback on is when one of my agents puts in an offer, I call the listing agent right after the offer goes in, introduce myself, let them know how strong the buyer is, give them a little bit of information, their credit score, their debt ratio, just try to pump up the offer a little bit. And I've had a lot of listing agents, tell me that they were shocked to hear from me and they appreciated the call, and it's made the difference. So that's worked out pretty well for us. But
How about best practices? So what would you want to see an agent do for you? At what point do you want their buyer? I mean, obviously I push to get as soon as possible, but what advice do you have for agents on what they should be doing to work with you?
Yeah, I mean, the earlier we can get them pre-approved, the better. I mean, I'm sure you've all come across that before, where you show somebody some houses and they kind of drag their feet getting pre-approved, and then you come to find out that they're just not really qualified to buy something. So the earlier the better to get them on the phone. And I will say, people are hesitant to have their credit report run, and sometimes to send over their personal information. So where I start with everybody is just a conversation. Like, tell me a little bit more about yourself. What is your credit score? I've got great credit. Okay. How much, what kind of debts do you have? I only have a car payment. Okay. Like, some people really know what their situation is, and they can be very, I can get a really good feel like, hey, we can run with this person. I don't necessarily need their credit report right now, because I feel confident that they're good to go. Other people, it's like, well, I've got about $5,000 for my down payments, and I just started this job, but I was doing this and I was doing this, and I've lived here, and you can, that initial phone call is going to be really telling in terms of what can be done. So yeah, sooner the better on the initial outreach, and then I think that would be the advice. There's not a whole lot more that we really need the agents to be doing. If you are interested in in the buy down and doing a temporary buy down, we should have that conversation too. And then the other thing I'll say is, when your offer is going in, be in touch. I'll write up a pre-approval letter specifically for that house, for that offer, and we'll make sure that it matches up with what you're putting in, so that you're maybe not showing somebody that this person can qualify for hundreds of thousands of dollars more than what they're actually paying, because the seller might want more money at that point. So
I think that earlier is better, right? How many times have we talked about borrowers or dealers that months before they actually go into a contract, and done all the work ahead of time, so the offer's clean. We talk about departing residents, that's addressed. So all of that ahead of time, and they're all and in some cases they may not qualify right then for what they're looking for, but you can set the guidance for them to get there, and then in 6 months maybe they'll get into the home they want. So I would definitely add that this is very normal, that we're talking about borrowers months before they actually go into it's the journey that gets you there, right? So.
Absolutely.
Yeah.
Yeah, and I even push a little harder on that. Getting started, even with if they run their own credit through Equifax or all these different programs now, they get their free credit reports, do it themselves. At least have an idea of where they stand. If they think they have high credit or they say they have good credit and it ends up being trash, it's bad income in, bad income out, right? Or bad input, bad whatever, output, whatever. So pushing these guys to get pre-qualified, pre-approved. I mean, quite literally go as far as you possibly can with income verification, with tax returns, with you name it. I mean, I'll push my buyers to go, 9/10 of the way early on. So if there are any issues, prior to writing the offer, it's going to save you, your buyer, that seller a lot of heartache and make that transaction way smoother if you know the hurdles going in. So.
Yeah, yeah, and I think that's probably the key thing to punctuate with them is like, look, we can spend all this time doing this, but if there is some sort of unknown issue that we need to address, we want to know it now.
Clean it up.
You want to know it now. Do you really want to like spend all this time, all this effort, get your hopes up, all these things, if you can't qualify? So it's everybody's best interest to be prepared.
It's an emotional buying a home. It's very emotional. It's and you want it to be smooth and a good experience. But I see a lot because I'm obviously a lender, so I see a lot of this. And many times it's not what the borrower is, has explained to their broker, and it does cause duress because they don't qualify as they thought they did, or something as you mentioned, the credit is not what they thought. It's maybe they pay everything on time, but they have high balances, which is a big factor on a lower score. So yeah, getting ahead of that, knowledge is key, right? More questions, more answers. And it also, I think, speaks to the commitment of the buyers when they're willing to give you all this in the early stages, right?
For sure.
Yeah.
Let's see. The question says, what situation would a buy down be beneficial for the borrower? I think it's one of those things that could help anybody, right? Like typically I would say on like a $700,000-800,000 home, you're probably going to have your payment come down by $800 a month, or maybe $1,000 a month in the first year, and then $500 in the second year. So it's it can be really helpful because the other thing to think about is a lot of people are buying a house and they're coming from renting and their rent is a lot lower. So this gives them the opportunity to kind of like maybe have their payment just go up a little bit from their rent, and then the next year it goes up a little bit more. They're also probably coming up with a lot of their savings for the down payment and closing costs and everything. So this might give them an opportunity to stack a little bit of money again before the payment jumps up. It's if the payment's not an issue for somebody, I think a lot of times instead of doing the buy down, you can still negotiate a credit and use that towards closing costs, which can be better for some people. So they're just coming up with less money out of pocket. It's different for different people, but the buy down is awesome for people who are experiencing payment shock, basically.
Right.
Sweet.
And our note thinking rates are coming down, right? And this will, there's sellers willing to do it, but I think a lot of times when the seller's willing to give a credit, we aren't thinking of using that as a buy down. So that's just another, option, which is really nice of them to offer and get educated, right?
Sweet. Well, Trish, thank you very, very much for jumping on and kind of running through some of your guys' programs. Bill, thank you for jumping on as well. Once again, for any link agents who don't know Bill, give him a call, introduce yourself, send an email, say hi. He's very, very good at what he does and helps us in a ton of tough situations. So, yeah, thank you guys for jumping on today.
Yes, thank you very much.
All right.
Have a great
Thanks,
day.
everybody.
All right.
All right, see you guys.
Thanks, guys.
Take care.